Imagine this. What if you had, like, a secret weapon? An invisible team of market whisperers just sifting through mountains of data,
Uh-huh.
not just telling you what happened, but maybe hinting at what's about to
That's the
happen.
dream, right?
Exactly. That's the kind of edge we're diving into today. We're looking under the hood of this incredibly sophisticated options trading strategy. It's designed to cut through all that market noise and, show you where the real opportunities might lie.
But what's truly remarkable here, I think, is how multiple really advanced analytical systems, you mentioned names like Cassie, Dota's, Edge Nexus, OmniProfit Nexus, AlphaCore,
Mm-hmm.
they don't just operate on their own.
Right.
They actually converge. They create this single dynamic framework. So today, yeah, we're dissecting their unified option strategy for September 4th, 2025. We're focusing on the SPDR S&P 500 ETF Trust,
Yeah.
SPY, the Grayscale Bitcoin Mini Trust ETF, the BTC ETF Mini, and of course, Tesla TSLA. And all the while, we're keeping a very, very keen eye on the SIBO Volatility Index, the VIX. We'll explore their specific strategy. They call it the Controlled Fragility Barbell, its core parts, and crucially, the meticulous risk management that really makes it all work.
Okay, so for you listening right now, what does this all actually mean? I mean, even if you're not an options trader yourself,
Yeah,
understanding this level of systematic thinking, it offers really invaluable insights, doesn't it?
absolutely.
It's kind of like a masterclass in how market dynamics are really seen, how risk is precisely managed, and where potential opportunities get identified, not just, guessed at.
Exactly.
Yeah.
So stepping into September 4th, 2025, the big picture, the market regime, is what these systems are calling controlled fragility, or maybe transitional risk-on.
Controlled fragility. Okay, what does that actually feel like in the market?
Well, on the surface, the VIX, it's pretty low. It's hovering around, say, 16.29 to 16.40.
Which normally sounds calm.
Right, typically screams complacency.
Mm.
But beneath that calm surface, there's this persistent hum of underlying risks, Especially when you remember September, historically, it can be pretty volatile.
Oh, yeah. September scares people.
It does.
Yeah.
So it's not genuinely peaceful. It feels more like a fragile calm before maybe things get a bit unsettled.
Yeah, that idea of underlying fragility, it really clicks when you look at some of the conflicting sentiment signals out there. Like, the crypto fear and greed index is bang in the middle, neutral 51-52, kind of indecisive.
Right, shrugging its shoulders.
But then you flip over to the traditional equity folks, the AAI sentiment survey, and it's showing a bearish lean, like 39.4% bearish versus only 34.6% bullish.
Some mixed messages.
Totally. These mixed signals create this really nuanced and honestly kind of tricky environment. It's not clearly risk on, not clearly risk off.
And that complex backdrop is precisely why the core strategy is called the Controlled Fragility Barbell.
The barbell, okay.
Yeah, think of it visually, a barbell. Heavy weights on each end, but not much in the middle. The key insight here is you don't actually need a crystal ball to predict where the market's going.
Right.
What you need is a system to capture the energy of the moves, whether it's up or down, while staying protected from that messy, volatile middle ground. This strategy really aims to profit from the edges, the extremes of market stability, let's say. Allocating investments to two different poles. Strong downside protection and high upside potential. It breaks down into three main components. On one end, the left tail, you build that downside protection. That's primarily through SPY put options.
Okay, the safety net.
Exactly. Then on the other end, the right tail, you have your convexity plays. These are designed for significant upside potential. We're using BTC and TSLA call options for that.
The big hitters.
Potentially, yeah. And then finally, the centerpiece acts as this crucial conditional hedge against sudden, unexpected spikes in volatility. And that's where the VIX, or UVXY call options come in.
Okay, so this is where it gets really interesting for me. It's not about taking a hard stance like, I'm bullish or I'm bearish.
No, not at all.
It's more adaptive, right? Almost like a chameleon,
Right.
Positioning yourself to do well whether the market swings up or down, but always keeping those guardrails firmly in place.
That's it exactly. It's
Yeah.
about being prepared for anything
Yeah.
rather than just betting the farm on one outcome.
All right, so if the controlled fragility barbell is the blueprint, who are the key players? The assets involved. You mentioned SPY, BTC, Tesla.
Right, let's assign them roles. Each asset has a very specific job in this setup, almost like actors in a play. First up, SPY, the SPDR S&P 500 ETF. That's the anchor.
Okay.
Think of SPY as the market's heartbeat, representing the broad S&P 500.
Mm-hmm.
It serves as either a stable core for the portfolio or, more critically here, our main hedging tool.
No.
Now, its current status is a bit ambiguous. Some signals say it's heavily overbought. Others are more neutral, which kind of reflects that market fragility we talked about.
Yeah, that conflict again.
And we're seeing signs of institutional distribution. Big players may be selling it to strength. So, the primary play for SPY, buying slightly out of the money puts, specifically the September 6th or 12th expiry 640 strike puts. We're allocating about 3% here.
Conservative.
Yes, it's purely for that fragility hedge and downside protection. Key levels to watch. Resistance is maybe $645, $648, but the critical level is this fragility shelf around 640, 641.1.
Fragility shelf. So if it breaks that.
Exactly. Think of it like a structural support. If SPY breaks below that $640 level, the market's underlying weakness could suddenly become very obvious, and moves down could accelerate pretty fast.
Got it. Okay, who's next?
Next, we have the BTC ETF Mini. We're calling it the gatekeeper, or maybe the leader.
Bitcoin's proxy.
Right. This ETF tracks Bitcoin, and it's often seen as a leading indicator for broader risk appetite. Why? Because it's volatile, and you see institutional money move in and out quite quickly. Right now, it's showing what the system's called cheap implied volatility, around 42%. That's relatively low for Bitcoin. Plus strong inflows, over $8 million just yesterday. And there are positive catalysts, like news about a potential Trump stake floating around. Our CSC model actually gives it the highest risk-reward score, an 80.
Wow, okay.
So the play here is buying the BTC ETF October 17th expiry, 53 strike calls. Smaller allocation, 1.5%. The goal is to capture momentum convexity, leveraging its role as that bullish gatekeeper. Key levels. Momentum really kicks in above $50.50 for the ETF, which corresponds to about $112,000 for spot Bitcoin. Resistance is around $52 for the ETF, or $112,600 spot.
Okay, so anchor, SPY, gatekeeper,
Yeah.
BTC. What about Tesla?
TSLA. That's the amplifier.
Aptly named.
Definitely. Tesla is a high beta, high volatility stock. It can seriously magnify broader market moves, especially because of the massive options activity around it. Currently, it's looking extremely oversold. The RSI is down around 22.9, which strongly suggests a bounce could be coming.
So a contrarian play almost.
Sort of. The primary play is buying the TSLA September 6th or 12th expiry, 335 strike calls. Allocation here is 2%. We're aiming to capitalize on that potential oversold bounce and, importantly, potential gamma activation if it breaks above the $340 resistance.
Gamma activation. We'll need to unpack that.
We will. That $340 level is key. It's the gamma flip or momentum trigger. Resistance goes up to about $343, and there's a fragility shelf or support down between $326 and $330.
Okay. And finally, the VIX. It's not really an asset we trade directly in this part of the strategy, is it?
Not as a core position, no. The VIX acts as the fragility index. It dictates the overall risk regime.
Gotcha.
It measures the market's expectation of future volatility, and it's critical for influencing our hedging strategies. As we said, it's currently around 16.3, 16.4 low vol, but fragile. And this is where the dynamic hedging comes in. There's a specific VIX trigger matrix. It guides how we scale into UVXY September 6th strike call options as the VIX itself rises. It's not just a static rule. It's designed to be responsive. For instance, maybe initiate a small hedge if VIX hits 16.5. Activate a full hedge at 17.0. Maybe start reducing that hedge exposure if VIX hits 18.0 or 20.00. And if things get really crazy, like VIX hitting 25.0, the protocol is to close all risk.
Wow, okay. That's a very structured response system. It's one thing to lay out a strategy with such precision, but the real magic, you said earlier, is how these roles and plays are decided. It's not just one person's hunch.
Not at all. It's the symphony, as you put it, of these advanced systems working together.
Right, this multi-system synthesis.
Exactly. So KC isn't just scoring a risk reward. It's running thousands of market simulations constantly, checking how different portfolio setups might perform under stress. It gives us a probabilistic edge. You know, DOTUS version 2.0 dives deep into convexity and gamma dynamics. It's basically mapping the hidden plumbing of the options market, the forces that amplify moves. Edge Nexus gives us execution insights and really focuses on that market fragility, trying to pinpoint where the market is most likely to break or bend.
Okay.
OmniProfit Nexus brings in momentum divergences, contract health, spotting maybe where a trend is weakening or about to really take off. And then Alpha Core version 3.15 is like the conductor. It's the real-time execution engine that pulls all these diverse insights together into actual actionable trades. And the key thing is, despite their different angles, they mostly agree on this controlled fragility regime and the barbell strategy. Alpha core synthesis confirms it.
And what's interesting here, there was apparently a period where the sheer complexity of all these layers was questioned, right? I saw a reference to an apology.pdf.
That's right. There was some initial skepticism about whether it was maybe overcomplicated, but the analysis, including that document, basically validated the approach. It showed that the multiple layers weren't redundant. They provided different, valuable perspectives, generating profits and managing risk effectively.
Okay, but for those still wondering, what's the biggest trade-off then? If you build such an intricate, multi-layered system, where does the complexity itself become a potential vulnerability? Or does it?
That's a really sharp question. The potential trade-off is often in, say, processing demands or the risk of miscalibration if one system goes offline or gets bad data.
Mm.
But the point highlighted in that analysis, the apology.pdf, was that the emergent insight from having these multiple layers, their ability to cross-validate each other, actually reduces overall vulnerability. Each system is like a different sensor. If one, the others act as checks and balances. So the complexity isn't just for show, it's intended to create robustness, resilience.
That makes sense. Okay, so let's get into the mechanics you mentioned, like gamma. What powers those precise moves within the strategy? It sounds like a deep understanding of options mechanics is key here.
Absolutely crucial. Let's break down these core concepts because they explain how these positions can generate those outsized returns or protect on the downside. First, convexity. Okay, imagine driving a car. Linear movement is press the gas, go faster at a steady rate.
Right.
Convexity is like having a supercharger kick in. The harder you press the gas, the more powerful each extra bit of pressure becomes. You gain speed exponentially. In options, it's that nonlinear thing where the options price changes more than you'd expect based on the underlying stock's move. Our BTC and TSLA calls are convexity plays, aiming to profit from those amplified nonlinear moves.
Got it. More bang for your buck, potentially.
Potentially, yes. Then there's gamma. Gamma measures how quickly an option's delta changes. Now, remember, delta is how much the option price moves for $1 move in the stock.
Yeah.
High gamma means the delta changes fast. So the option's price can accelerate dramatically, even for small moves in the underlying stock. With TSLA, high gamma means once it crosses a certain price, those calls could really explode in value because the market suddenly has to react much more aggressively to hedge.
Okay, so gamma is like the acceleration of the options sensitivity.
That's a good way to put it. Related to this is gamma density or concentration. These are just specific price levels, specific strikes on the options chain where a lot of contracts are clustered.
Like a traffic jam of options?
Kind of. This concentration forces significant hedging activity from market makers, the dealers. If tons of call options are sitting at, say, the SPY 650 strike, dealers who sold those calls will need to buy SPY shares more aggressively as the price gets closer to 650. It creates this sort of magnetic pull or push.
Ah, okay. Which leads us to the dealers themselves.
Exactly. Dealer positioning. Are they short gamma or long gamma? This is critical. Dealers try to stay neutral, so they hedge constantly. If they're short gamma, which often happens when they sell options to the public, they are forced to buy the underlying stock as its price rises and sell it as its price falls to stay hedged.
So they chase the market.
Yes, and that forced buying or selling amplifies the price moves. So when we talk about TSLA approaching a gamma flip level, it means dealers might be forced into buying more and more TSLA shares, literally pushing the price higher, faster.
Wow.
Conversely, if dealers are long gamma, maybe they bought options, they do the opposite, sell into strength, buy into weakness, which tends to dampen price moves. It acts like a shock absorber.
Okay, so knowing dealer positioning is key.
Hugely important. And finally, you might hear terms like convexity cliffs or ladders. These are just specific price levels where those gamma fix we talked about are expected to really accelerate significantly. Think of them as trigger zones, creating breakout potential or amplifying moves for SPY or TSLA, like hitting a ramp.
Okay, so when we talk about TSLA's gamma activation above $340, now I get it. It's not just a line on a chart.
Right.
It's a point where the market maker's own hedging could kick in and actively accelerate the price move, creating those monster swings TSLA is famous for. It's like a feedback loop.
Precisely. It's a feedback loop baked into the market structure.
That sounds incredibly powerful, but it also sounds like something that needs really tight control. You could get wiped out fast if you're on the wrong side of that.
You have absolutely hit the crucial point. To navigate this controlled fragility market, you need rigorous, almost non-negotiable risk management protocols. They are essential for survival, let alone profit.
So what are the main rules?
Okay, position sizing is rule number one.
Yeah.
Maximum 3% of your capital in any single strategy, SPY, TSLA, or BTC.
Yep.
And total options exposure is capped at 20% of the entire portfolio. No exceptions.
So no all-in bets.
Absolutely not. This prevents any one trade from blowing up the account. Then stop-loss protocols, these are hard stops, set below key technical levels. Like if TSLA drops below $323, you're out. BTC ETF below $47, out. If you're holding SPY puts and SPY closes above $648, you cut the position. And for the options contracts themselves, a very common trigger is just a 50% loss on the premium paid. You cut your losses quickly. It's about capital preservation, always.
Makes sense. Preserve capital to trade another day.
Exactly. Then there's the dynamic hedging we talked about with the VIX. Using those UVXY calls based on the VIX level, it's proactive defense, not waiting until you're already losing big.
Right.
And finally, correlation limits. The strategy aimed to keep total portfolio correlation below 60%.
Why is it important?
It limits same direction risk. You don't want everything going down or up at the exact same time. It helps mitigate contagion risk. Like if Bitcoin suddenly tanks, you don't want it dragging your entire equity book down with it just because they happen to be correlated that day.
Diversification of risk, even within the strategy.
Okay.
What's fascinating here, though? Beyond all these sophisticated rules and layers, you mentioned there's a critical kill switch protocol.
Yes.
That sounds drastic. Like break glass in case of emergency for the entire strategy. What's the thinking behind such an absolute measure?
The kill switch protocol is it's the ultimate emergency brake. The philosophy is simple. When markets enter genuinely chaotic, unpredictable, black swan type conditions, the number one priority, above all else, becomes capital preservation. Forget making money, just don't lose everything.
Okay.
So the protocol dictates that all long exposures, your call options, any underlying stock positions must be immediately flattened, wiped clean off the books. But crucially, your defensive positions, the put options, the VIX or UVXY hedges, those are maintained, maybe even increased, to protect the remaining capital.
And what triggers this? It can't just be a bad day.
No, it's triggered by specific severe conditions that signal systemic stress. Things like SPY dropping below that key $640 level, and at the same time the VIX spiking above 18, or if BTC collapses below $47.50, or if cross-asset correlations suddenly spike above 0.9, meaning everything is moving perfectly in sync, which is usually a sign of panic.
So it's when the basic market structure seems to be breaking down.
Exactly. These triggers aren't arbitrary, they're chosen as indicators that the normal rules might not apply anymore, and it's time to go into pure defense mode.
Okay, wow. So having the brilliant strategy, having the robust risk management, that's huge. But you still need to know when to act, right? Timing is everything.
Absolutely.
And this system, it seems to break down the actual trading day into precise execution windows, almost like a military operation or a detailed play-by-play.
That's a good analogy. The execution framework is highly time-sensitive, specifically calibrated for September 4th, 2025 in this case. First, the pre-market phase, say 9.000000 a.m. Eastern. This is all about final checks, confirming the directional biases from the overnight analysis, setting those VIX alerts we talked about, getting entry orders ready to go. It's the pre-game prep.
Okay, lining things up.
Then the opening drive, 9410000 a.m. This is often when the primary SPY strategy gets executed, typically initiating those puts as the fragility hedge, usually starting with maybe 50% of the intended size, waiting for volume confirmation. This is also when you're watching BTC and TSLA like a hawk for any early signs of strong momentum as the market digests the opening bell and any overnight news.
Got it. Don't jump in blindly.
Right. Next comes the momentum window, roughly 10:00 to 11:00 a.m. This is often the key opportunity add to winning positions. If TSLA breaks decisively above $340, or if BTC confirms its leadership role above $50.70 for the ETF, this is when you'd likely complete your position sizing, pressing the advantage on the confirmed trend.
Riding the wave.
Pretty much. Then you enter midday management, let's say 11:00 a.m. to 2:00 p.m. This is more about monitoring, watching for any signs the market regime is shifting. It's also where you might start scaling out profits, maybe trimming 50% of a winning position when it hits an initial price target, and constantly adjusting those hedges dynamically based on the VIX and market action.
Taking some chips off the table.
Exactly. Lock in some gains, reduce risk. Finally, the session close from 2:00 p.m. to 4:00 p.m. The main focus here is exiting any 0 DTE 0 days to expiration options well before the close, usually by 3:30 p.m. Eastern to avoid pin risk. You'd also be trailing stop losses on profitable positions you intend to hold overnight and very carefully calibrating your hedges, like the SPY puts or UVXY calls, to manage any overnight or weekend gap risk.
Okay, that is incredibly structured. This whole deep dive into the controlled fragility Marble strategy, it really shows a truly dynamic way to navigate the market, doesn't it?
Yeah.
It's about being prepared for, well, almost anything, not just pinning your hopes on one single outcome. It really highlights the power of being adaptive.
And if you connect this to the bigger picture, I think the real genius here isn't just one system or one clever trade idea. It's the intelligent synthesis of all those multiple analytical viewpoints we discussed,
Right.
coupled with that incredibly disciplined, almost rigid risk management. Is really a testament to how deep understanding in these adaptive protocols, even in a tricky, controlled fragility environment, can potentially provide a significant sustainable edge in today's markets. It's about trying to turn that perceived chaos into something more like predictable patterns you can act on.
It really does. And it raises, I think, an important question for you listening now. As these kinds of analytical systems become even more sophisticated, even more integrated, how might they fundamentally change the very nature of market trading itself?
Yeah.
And maybe more personally, what new skills will you need to develop to stay ahead, to thrive in a world that's increasingly driven by this kind of complex computational intelligence? Something to think about maybe until our next deep dive.